This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 18th. Some highlights from today's show. EU fiscal rules are changing. Bitcoin is weak, bro. And Fangs maintain momentum. Good day traders, and welcome to another daily market rundown. Let's get stuck straight into it. Obviously yesterday was a US bank holiday, so not a great deal to report back on in terms of yesterday's session. It was very much muted. However, if we look, the key standout again yesterday was Europe, with the DAX up another 1.4%, as well as FTSE MIB up 1.4%. And we'll talk a little bit in a moment about why that is. Why is it that Europe is now outperforming so significantly, and ultimately what can we do about it as traders? But let's turn our attention to our first news article today, and that's all about ultimately the EU and the talk going around the markets about joint spending. Now, to give you an idea of this, it's very important we talk a little bit of EU history. Perhaps some of you don't really understand that if you go back as far as 2010 to 2012, when we had the European crisis, to give you an idea of what happened, the likes of Spain and Italy had 10-year bond yields up around 7.5%. Effectively, we had investors, market participants talking about the end of the European project. Now, fast forward, ultimately what was put on the table back then was some form of an EU joint bond. In other words, we all come together, we all agree to issue a bond, and we all effectively have a liability for that bond. In other words, we issue debt, we raise money from the market, and we all agree to pay it back. Now, back then it was, of course, the likes of Germany and Netherlands and Austria that were the key sort of pushback against this. And I said, absolutely not. We will not be taking on any risk of the southern states because they cannot manage their own fiscal. Fast forward to COVID, it was again a repeat situation. So fast forward 2020, there was an emergency around the world, and again EU leaders stepped up and said, look, hey guys, how about this EU bond thing? Let's give it a go. Let's issue joint debt where we all share in the liability. Again, it was who? It was Germany who stepped up. It was Netherlands who stepped up and said, absolutely not. We fiscally responsible. We will not saddle the debt of some of the other countries. Fast forward all the way to 2025, we now have a situation where Germany, France, and the UK are talking about a joint issuance of EU bonds. The irony should not be lost, of course. Who is the economy that's now currently in a recession for the last 2-3 years? It is Germany. And of course, some of the southern states like Spain and Italy have been really outperforming over the course of the last couple of years. So there's a lot of irony in it, and I think it's important you understand that history. But the key blocker of joint issuance was always the northern states. The fact that they're now talking about joint issuance, some form of an EU bond, is incredibly important, not just for Europe, but ultimately for the defense of Europe, for the defense of the world, and for global economic trade. Now, what's the sort of the general idea? Well, there's a lot of sort of whispers going on. The general thinking is that the EU would need to come together and sort of bring up 3.1 trillion over the course of the next 10 years in order to expand their militaries to be able to defend against, of course, what's going on in Ukraine, Russia. All of this was prompted, of course, by Donald Trump taking a step back, saying, look, perhaps NATO is not going to defend you in a future type scenario. And so now EU leaders are becoming serious. They all recognize the need for joint spending. And again, I think the key number I want to throw out there is 3.1 trillion, because if we look back at the first bit of joint issuance that happened during COVID, it was to the tune of 750 billion euros over a number of years. Okay, if we look at this, 3.1 trillion over 10 years, that's 300 billion of issuance every single year. That is a significant amount of issuance. And yes, there's the one side of the coin, which is it's more debt that Europe is taking on, and we know Europe is already quite indebted. However, the flip side of that is we've seen in the United States what happens when you do ramp up fiscal spending. You get growth of 2-3%. Okay, so the flip side of it is if the money is well spent and it is pumped into the real economy, we should should see Europe start to not just grow, but ultimately outperform some of the other economies. Okay. Now keep in mind the US has been the star outperformer for the last 2-3 years. All the money has flowed to the US. It's why US stock markets are recording these record highs after record highs. Everyone just simply wants to be invested in the US. I think now the tides are starting to shift. We're seeing European countries finally starting to realize that fiscal spending is a way to generate growth, and perhaps now is the opportune moment to do it, given we have this problem of a lack of defense spending in Europe. Okay. Now, what I want to point out is talks are still underway. There's nothing confirmed. The general consensus and thinking is there is going to be some degree of a splurge. It could come from a number of different avenues. It could come in the form of an EU bond. It could be some sort of a special program similar to what we had in terms of the COVID bonds or the Corona bonds. It could also come in the form of taking the funds that were not invested from the Corona bonds or the EU vision plan and reinvesting those. The point is that Europe is now finally getting serious about spending, and if that means they're going to spend, it means they're going to issue more debt, and ultimately that is going to create a little bit of volatility in bond markets around the world. So keep a close eye on that. I think this becomes topical. I think it becomes a narrative that we'll understand, of course, post the German election. We're not going to find out too much details about this until, of course, Sunday has cleared, and I suspect we do get something next week or towards the end of the month about what exactly is the thinking in the EU right now about this fiscal spending. Okay, pay very close attention. It is going to put pressure on bond yields. Of course, we live in an environment now where inflation is still above target in most countries around the world, so this is going to put further pressure on, of course, bonds in general. Now, just to showcase what's happened in the market, because obviously as traders we're only picking up on this information now, but very clearly these talks have been underway for some time now, and we can see that in the DAX. I think you look at the DAX since sort of the start of this month, and we're up 7% at the start of the month. We're now up 14%, so we've rallied like magic fairies, 7% on the back of absolutely no fundamental change, whilst at the same time if we look at the S&P 500, it's mostly flat over the course of the last 3-4 weeks. Point being that we can see this news has been in the market. We can see that the German DAX is showcasing this spending coming down the pipeline. Of course, there is also the fact that the ECB is cutting rates, as well as, of course, there is talk and chatter about a conclusion to the Russian-Ukraine war. But at the heart of this rally is very much this idea of fiscal spending. So keep a close eye on that DAX. I think there's every possibility that we do get some form of a consolidation in the near term, some sort of two-way trade. But once we get more clarity on the size and degree of this fiscal spending, don't be surprised to see that DAX ignite and stay the outperformer this year. I think it's very, very key that right now DAX is a market that you want to be long of. You want to be trading the strong market that is, of course, outperforming. Okay, let's turn our attention then from Fed's Waller. Just a brief update. I think there's a few interesting things he said, and the key takeaway is, hey, look, I want to keep rates where they are until we get more confidence on inflation. But he said something very interesting, which is that his baseline, and I think this is worth mentioning, his baseline is that the tariffs coming in via the Trump presidency are not going to prove anything other than a short-term blip in inflation. In other words, you think there'll be some short-term inflation sort of pressure, but he's saying that they should just look straight through it. Okay, in the same way that they looked through the impact of the Russia-Ukraine war, they didn't overreact. In the same way they didn't overreact to the banking crisis that we had in 2023 in in 2024 in March. He's saying we should also look through this. Don't overreact, because that's not how you determine policy. Now, this isn't necessarily news. I think this is very much Powell's stance, which is, look, yes, inflation pressures are rising in the near term, but we're happy to look through that because we think our policy is still currently restrictive. Okay, so just make sure that you do take a read through. I think that's quite an important little chart. On that note, let's turn our attention and look a little bit at those inflation expectations. What you've got ultimately in the green is the Fed's rate cut. You can see they've begun cutting rates in September last year. But at the same time, what we notice is, look at what those inflation expectations 1 year out have done. Okay, ever since that rate cut cycle has started, we can see the 50-day moving average of 1 year inflation expectations is not just going straight up, but it's really going up at some clip. Okay, we are moving higher quite aggressively on these inflation expectations, and I suspect that is something that's going to continue higher if the Fed is going to maintain the stance of we're going to look through inflation, we're not concerned about it. Does it matter? Well, look, the Fed doesn't make policy based on one-year inflation expectations. They make policy based on what their inflation expectations are over the medium term. Okay, but inflation expectations are rising, and what that means is gold is going to stay bid. It's going to be an outperformer so long as we see inflation expectations continue to rise. So do just factor that in when trading the gold. Now, I put out a little article here that Bitcoin is weak, bro. And the reality is, if you go and have a look at the performance of Bitcoin over the course of the last couple of weeks, it very clearly is underperforming. There's something going on at a price action level. Now, this is not my fundamental beliefs of whether Bitcoin should go up or down. It's just price action is pretty weak. And so we need to understand that. We need to interpret it. We need to make sure that we recognize there is opportunity scope within Bitcoin. Now, if you look at Bitcoin in yellow, okay, that is the performance this year. We can see we opened, we rallied quite aggressively. We were up 15% at some point, and now we're pretty much flat, and we've done absolutely squat diddly do over the course of this month. We've just been in a very tight consolidating range, okay? At the same time of the course of this month, we can see that the dollar has weakened. So in the euro, we can see that we're now up 1% in the euro against the dollar. Okay, so there is a little bit of dollar weakness coming through. Now, straight away, dollar weakness should be positive for Bitcoin, not negative for Bitcoin. So that's a key sort of thing to be aware of. Bitcoin typically does well when the dollar weakens. The second thing to be aware of is we can see that over the course of the month, okay, the S&P 500 is up 2%. And yet Bitcoin ultimately is, since the start of the month, is actually down around 6%. So we've seen these equity indices rally back up to record highs. We can see the risk on sentiment in the equity indices, but Bitcoin is not partaking in that sentiment, which again is another red flag. Bitcoin typically always runs ahead of the sentiment, not behind it. And then finally in the pink, we've got gold. And we can see gold continues to shine. It's up 4% again this month. And again, just comparing it to what Bitcoin's doing, we can see that they are moving in opposite directions. Now, what is going on in Bitcoin? I don't know. Okay, I have no absolutely clue. I'm not going to be a newspaper now and give you some fundamental bullshit reason as to why Bitcoin's going down. But what I can tell you is the price action is quite weak. There's not a lot of interest to be long Bitcoin right now, which I suspect means we are going to go and test that 89,000 area again. Do we break it? I don't know. Do we have a liquidity stop below it? I don't know. All I know is that 89,000, it's been bought up there twice in the recent months. It's proving to be a very popular area to be long of Bitcoin. However, with this price action, I suspect it gets tested pretty soon. And then it's a question of what happens there beyond. Do we break below it and perhaps move all the way back down to that 72,000 level? Or does it get supported again and we just pivot our way back up towards those highs made earlier this year? I don't know. The point is, price action's weak. It's not a market you want to be long of right now because I suspect you are going to get lower prices in the near term. And then finally, let's turn our attention to the Fangs. They are right back to where we expect them to be, which is those record highs. And I think the key takeaway here is that Fangs just continue to outperform. Okay, that trend has been just so strong since July last year. You can see how every single dip just gets bought up. Even, of course, the shallow dips when we do have some deep-sea concerns, perhaps some softer earnings expectations. The point is that the FANG and the Mag 7 continue to bite, they continue to lead, they continue to show this underlying strength. We can see NVIDIA all the way back up at that $140 mark, a really good rally over the course of the last 3 weeks. They continue to prove to be very, very strong. Now, why I'm showing you this chart is because, well, we are at record highs in indices. I think FANGs will support that breakout into record high territory. But the caveat is when you have very sharp trends like this that have got very shallow pullbacks, at some point this fuzzy little line, whatever you want to call it, at some point it's going to be very useful to lean on. Okay, and I suspect that recent low we made end of Jan, beginning of Feb, I suspect that recent low is going to prove to be a very, very important area to pay attention to. We break that, we will get that little bit of a corrective type move. But again, and this is a key tip, I've made this mistake a number of times in my career thinking, well, at some point they're going to break it, therefore I want to be short for it. The reality is you never need to preempt the break of these lines. Okay, typically speaking, when you have these very steep, strong trends, once they do break, they'll typically break and give you plenty of opportunities to trade on the other side. So you don't need to pick tops here. You need to stick with the trend, stay with the trend until the trend tells you it's broken. And at that point, you flip the book and you turn bearish. All right, that's then, of course, a wrap for today's session. If there are any other questions, do post them in the Discord channel. And the question of the day in the comments field, What do you think about Bitcoin, bro? Do you like it here? Do you want to buy it? What do you think's happening? Why is the price action so weak? It would be interesting to get your feedback and comments on that. Good luck out today. There's not too much in the way of economic data. We do, of course, have the OPEX later on the week, and I suspect that is ultimately going to get most people's attention, but we'll talk a little bit more about that as we head into the latter half of the week. Good luck out there. Manage that risk. Go make some money.